Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Appleman Properties. We're joined today with Brie Schmidt. Brie is a successful real estate broker, investor, event co-founder, and world traveler with notable achievements in the Chicago and Milwaukee markets. Brie, we're excited to have you on today. If you could, just let everyone know a little bit more about yourself.
Yeah, thank you for having me. So I started investing about 12 years ago. I did what is now called house hacking, right? So I bought a 3-unit property in Chicago, used an FHA loan, and that's how I started my career. I always had planned on this being a side hobby for me. I never really planned on doing this full time. I worked in corporate for about 10 years, worked 60 hours a week, traveling all over the world or traveling all over the country for business, and was pretty burnt out before the time I turned 30. So that's how I got into real estate investing. I started buying my portfolio here in Chicago, built that up, and then transitioned to the Milwaukee market. So when I had my full portfolio, I had about 31 properties, 91 units, excuse me, between these two markets. Then I started a brokerage firm about 9 years ago. So I run a team of 8 agents. We all pretty much work with investor clients. We did $60 million in sales last year. And then through that, I started a real estate conference as well. So we host the largest real estate investing conference in the Midwest. It's an annual conference. We just had it a couple of weeks ago in May.
Wow, that's
the short version. I know it's a lot.
You're staying busy. That's good. It's $60 million in sales. That's a good chunk of change for sure. So you had 91 units, and then you had sold off some properties. Is that correct?
Yeah. Right now, I'm down to, I can't even count, 16 units. I just sold the last of my portfolio in Milwaukee in March, actually. So it was interesting. I was at a conference. There was a conference in Philly, the Mid-Atlantic Real Estate Networking Summit. And the first speaker of the day was an economist, right? And he got on stage, and this was back in 2018, and started talking about like inverted yield curve, right? And all these things I didn't understand. And I was like writing them down, like Google this later, because I should understand these things, right? And at the end of the event, there was an auction, a charity auction, right, where you could buy speakers' time. And so when that economist came up, I bought his time, and I wanted to talk with him and learn more about, right? I know the real estate world, I know the local markets, but how other things, like how the bond market's going to affect real estate, right? How credit affects real estate, all those other things I wanted to learn about. So part of that process with him was he had asked me to send over all my portfolio numbers, right? So like I'm super big about accounting, right? I run my own system still when it comes to that. I do my own reporting. I always look back, right, where we're at year over year, where we're at quarter over quarter, right? Like I love looking at that kind of stuff. And I thought I was tracking pretty well on things. So it wasn't until I working with him, he had me look back like the last 8 years of my portfolio, right? And like really broke down my performance property by property, right? And area by area, that I realized like some of the properties I had were complete duds. I had very little cash flow. They were constant problems. I was spending all my profit on CapEx, and the market had shifted since when I bought. So I could sell them and literally get like 20 years cash flow up front. So that was what I did. I started selling off the properties that were my highest return. That was my trigger point for me, was looking at, the last 3 years cash flow, the last 1 year cash flow, right? Looking at those numbers, and then what I could profit selling it for. So my rule was, if I could get 10 years of cash flow up front, I was going to sell that property. So I sold a couple properties in 2019. I sold a couple in 2020. And then I didn't sell anything 2021, 2022, I sold 2, and then I ended up selling another 8 this year.
So with the economist, where he's telling you where the markets are heading and where they're at, was there going to be a negative appreciation in those markets, or what were?
No, that really wasn't the factor. He told me, this is back in 2018. So his comment to me was, sell anything that you're not willing to hold during a recession. Right. So, but really it was the cash flow was what the problem was. I was eating a lot of money into my CapEx. So for example, I had tenants that turned over, they'd been there for like 4 years, right? The unit rents for $800 a month. This is the C-class market in Milwaukee. It cost me about $8,000 in turnover costs. So like looking back, like I wiped out 2 years of my cash flow, right? And when you're dealing in C-class markets, like those sort of things happen quite often. When you're dealing in a B-class market, right, where your rents are, let's say, $1,800 a month, and you have an $8,000 turnover cost, it's not that big of a hit. But in that small cash, like that small rent number market, right, that's going to eat up such a huge amount of your cash flow.
Yeah, yeah, for sure. And a lot of it's, if you're buying a single residence, you can't buy for cash flow. You're going to buy for appreciation, have it as a wealth booster, and have it for down the road. But you're definitely not going to profit. One move out will just put you into the negative. That's I know you know that. I'm letting the listeners know as well.
Yeah.
It's more of a strategy of putting it on your balance sheet and having on your PFS as an asset, and to enable you to buy bigger and more properties. But you had mentioned C and B class properties. Can you elaborate on the differences of different classes of properties for the audience?
Absolutely. So, in my mind, right, the A class properties are properties that are generally like downtown in your core business district, right, where your cash flow is very minimal. You're looking probably at like 5 or 6% cap rate, let's say, more like a 4 or 5 actually. But your appreciation potential, right, is why you buy it. And these are not bad properties to have in your portfolio. Like you said, those are your wealth creators. When I compared my Chicago portfolio, which is more of a B class market, to my Milwaukee portfolio, my rent ratios were double in Milwaukee, meaning my cash flow was much higher for my acquisition price. But at the end of the day, after 9 years of being a landlord, Chicago is what generated the most wealth for me, was through my property appreciation, right? That's actually what added way more money to my balance sheet, was that. So that's your A market strategy, right? Most of your tenants are high-end tenants, right? They can pay, let's say, 6 months of rent in advance. They're not generally like throwing parties or damaging your units. Your units are nice, granite, stainless quartz, all those things. Then you got your B class market, right? And so your B class market is generally just outside your A class market, where people go to afford more space. So like my Chicago properties are a B class market. After 12 years of being a landlord, I can tell you my tenants are almost always couples in their late 20s, early 30s, right? Where they don't care about living by the cool, 4 a.m. bars. Like they're past that life, but they still want affordability, and they still want space, and they still want a nice unit. And they're typically looking to save up for something big, whether that be a wedding or having a kid. They have enough capital where if one of them loses their job, they can float themselves for a few months, but they can't go a whole year, right, without having income. Then you've got your C class market, right? These markets are, apartments that we typically don't see that have any sort of quartz, granite, stainless steel appliances, older cabinets, right? They're still decent apartments, but they're not higher end rentals. This is where your rents are typically like sub $1,000 a month. And these are tenants where if their car breaks down, it's going to cost $400 to fix. They don't have that money in savings. So now they're in a pickle where they have to get to work to make money to pay rent, but they can't pay rent because they have to use the rent money to pay for the car repair. You know what I mean?
Oh yeah.
So that one car breakdown is going to set them back for at least 2 weeks. And now they're trying to get caught up, right? That to me is like what the C class asset is.
Yeah, yeah, workforce, and it even goes a step lower.
It does.
The D class assets are, if you're a real estate investor, you don't even look at them. You don't walk them. You don't look at them unless it's the area is gentrifying and you feel like it might be on a path of progress. Possibly.
They're hard.
Yeah.
I mean, I always say, Chicago's a very diverse market. So is Milwaukee. Whenever I get, especially out of state investors will reach out to me on the agent side of things, say, hey, I saw this property. It's a solid 10% cap rate.
Yeah.
And I like, it's a 10% cap rate on paper. It is not a 10% cap rate in reality, because you're not running with 20% vacancy, right? And 20% repairs and CapEx. You're running numbers in a B class market to get that 10% cap rate. And that's just not realistic. The other problem you're going to have is scalability, right? One of the biggest lessons I learned investing in a C class market in Milwaukee, especially being out of state, was that you have to have scale. I would have been completely killed if I only had a couple of properties up there. Luckily, I had so many right? That when one property downturns, the other ones were there to balance it out, but also to make me a priority to property management. That's one of the things I always tell people is, if you've got a duplex, right, and I've got 70 units and we both have a vacancy, guess who's getting it rented out first?
Yeah.
I'm a priority. I represent a big portion of their business, right? They make sure that I'm happy. So if you're going to go into a cash flow market and your plan is to buy a duplex and then in another year look at buying another one, like you're going to get killed.
Yeah, for sure. And I was stuck on the cap rate for a long time. The higher the cap, I was looking for the high cap rates, and
Yeah.
you're chasing the rents, you're chasing the boogeyman because you're trying to collect rents that you're never going to receive, and ultimately at 10 cap is going to be even a 4 or a 5 at the end of the month. Plus, you're going through the evictions and the damages. You're for the audience, lower the cap rate, higher the value of the property, higher the cap rate, lower the value, higher the cap rate, lower the value. But there's trade-offs there. You're going into different submarkets, different areas, and there's also the cap rates return on a lot of metrics. But there's trade-offs on your demographic and your clientele, which is your residents.
There's like a 90s rap song that said more money, more problems.
Yeah.
Like that absolutely applies to real estate, right?
Yeah.
The higher the cap rate, I can guarantee you the more problems. My Chicago stuff has been great. I've been landlord here for 12 years. My returns are pretty solid, right? They're nothing to like write home about, but they're pretty solid returns, nice, solid 7% cap rates. My properties have doubled in value since I bought them 12 years ago. But the best thing is my tenants generally, like once a year, I have a problem per unit. I could go 3 months without talking to any of my tenants because there's never any problems. Like I just had a new tenant move in and she'd ask me, what's the process about repairs? Like, honestly, like the last tenant lived there for 2 years. I think I talked to her once. She had a clogged sink, and so once in 2 years, I got a phone call from her that there was a problem. Like you could do other things with your life, run other businesses, right? Grow your portfolio. You're not focused your time on managing deadbeat tenants, chasing them down for rents, right? It's much more stressful.
Yeah, and there's professional tenants that know all the laws, all the everything it takes to get in there and stay in there for as long as possible. So
for your listeners, I would definitely suggest before you consider any sort of real estate market is to research what the local laws are. Coming from Chicago, we have one of the strictest landlord tenant ordinances in the country. We are very, very tenant friendly, and Milwaukee is totally opposite. Milwaukee is very landlord friendly. So my evictions in Milwaukee usually I get a court date within 10 to 14 days, and I can get a writ in court that day. Chicago, you're talking about 6 months before you're lucky to get a court date in 6 months.
Wow.
It's a much longer process. When COVID was going down and all the restrictions, it was taking about a year and a half for an eviction to process. So those are very important things to take into consideration when you're looking at markets, right? And what kind of asset class you're going to be looking at as well.
Yeah, because the day when that property quits producing any kind of revenue, you're never going to get that revenue again. So 6 months, that's a long time.
A long time. That's even get the court date.
Yeah.
And then it always gets continued.
And then they'll get extensions and So have you invested with partners?
I have. I have 3 partners. They're all individual partners, so they don't know each other. So the remaining properties I have in Milwaukee is one of my partners that has wanted to keep the properties. Funny enough, they're all engineers from California, and I all met them through various networking events. So we've done like one-on-one partnerships. One of the things that I liked about what I did was I called it a courting period, right? So the first 2 introduced themselves to me, said, hey, I'm interested in partnership. I said, great, let's take some time to get to know each other and let me tell you about what I've been doing. So at the time I was acquiring my own properties in Milwaukee. So I would go on, I'd go do, let's say 20 showings in a weekend. I'd come home, I'd write my notes, and then I'd share it with them. Hey, these are the properties that I'm interested in. This is why I like these properties, right? These are the ones that I'm saying no to, and here's why. And then like every month I would share with them my reporting. Here's how we performed last month. Here's some of the problems I ran into, so-and-so tenant is on a payment plan. we decided to do a payment plan and not go through eviction. But I did this for like 6 months with them, right? And just like sent them emails and communicated like what I was doing in my day-to-day operations so that they got to know me. And that made it a really easy partnership once we actually acquired properties, because said I wouldn't even talk to them for like 6 months. They didn't have a lot of questions. They knew me. My third partner, I'd met at a networking event. And within, 3 months, we acquired our first property. He really he flew out to Milwaukee, I think 2 weeks after we met, and wanted to start looking at properties and really fast track that relationship. And then I ended up spending so much time on the back end, like getting him up to speed and explaining things to him that I didn't have to do with the other ones because I had spent all that time on the front end.
Nice. Yeah. And trust is built based on performance. So one
Yeah.
way to build trust is through communication, effective and actionable communication, just being in front of what's happening, where the projects are going, how they're performing, next steps, next moves. It's communication is key. It's huge, and just keeps everybody in the loop. Because I think when people don't communicate, people start to wonder. And then once people start to wonder, it's kind of things build up, and then you have if things happen. So, but what are some pros and cons that you've seen with investing with partners?
The pros are you can grow faster, right? The cons are you're now responsible for someone else's money. And that is a absolute huge responsibility. You have to really take that very seriously. The other cons are right, disinterested alignment of like goals. So I've had two of my partners, they decided to sell with me when I was selling my Milwaukee properties. One of them decided not to, right? The way that I wrote my agreements was that I had no ability to make any sort of decisions about when we sell. I did not, I wanted them to be able to make that choice. So making sure that's aligned, because if you're in a situation where the partnership goes south, right, and one person has control and one person doesn't, like I've seen a lot of really messy partnerships. Again, I was very lucky that I did my due diligence on my partners, right, and didn't want to just take anyone's money. I wanted to make sure the relationship was going to fit, it was going to work for both of us. So whether we kept them or we exited, right, it all worked out in the end. But really it takes an extra layer of due diligence. I'd much rather take a hit financially on my own properties with my own money than to risk losing partnership money.
Yeah, for sure. Absolutely. And that's, interests need to be in alignment, and personalities. When you're managing other people's personalities, you have to make sure that you're in sync, or it can become a miserable relationship.
I have a friend who also invests in the Milwaukee market, and they started off with their own portfolio, and then they very aggressively sought out partnerships. Hey, if you had money in a breath, right, they would work with you. And they ended up building up their portfolio quite quickly. I think they had up to 300 units at one point. And then within a year and a half, they had to liquidate a huge portion of their portfolio because of personality differences, right? Or they didn't spend enough time on the upfront with realistic expectations, and the partners wanted to exit. The problem they had, though, is they had commercial loans, which had due on sale clauses, or prepayment penalties. And at one point, he had sent me a small portfolio. I want to say it was maybe, let's say 40 units that he needed to offload quickly because the partnership turned sour. The prepayment penalty was $60,000 that they would have to take a hit on if they didn't find someone to assume the loan, right? And those are all things that like should have been worked out in the front end. And they ended up losing money on it because they needed to get out of the partnership and they couldn't find someone to assume the loan.
Yeah. And that's just one example of there's some horror stories out there, that's for sure. And it all boils down to everyone has different motives and why they're doing what, and got to make sure the goals are in line. So with you investing out of state, what have you seen as being some challenges, some good qualities of investing out of state, some pros and cons on that front as well?
There's definitely a lot of challenges. Luckily for me, Milwaukee's only an hour and a half away. So I'm not needing to get on a flight, right, and fly somewhere and plan something. So for the first 2 years, let's say, I was up there pretty much every other week, at least, managing my properties, managing the property manager, right, getting the portfolio set up and established. Once I got things set up with our property manager and was comfortable, I would then go up there for monthly meetings, right? And we would do that for about the next 2 years. And then once that really wasn't necessary, then I haven't really been up there very much. I could rely on their expertise, right? Pictures, videos, all those things. But really for me, it comes down to scale. So one of the things I did when I was acquiring the properties, so I acquired 18 properties in 9 months in my own personal portfolio. And then I acquired another 10 properties in the next 9 months with partners. So I had, 28 units in a year and a half in that portfolio up there. So whenever I would buy properties, if I saw that the investor was out of state, after we sold, I'd write them an email or send them or call them and say, hey, listen, I just wanted a few minutes of your time. I bought your portfolio, the deal's done, right? Like, I'm not looking for anything like bad information here, but I'm really curious why you sold. And a lot of them came down to, the maintenance costs were too high or the vacancy was too long and we were really getting killed on the numbers. And how I made that different was having scale. Like I said, I represented about 20% of my property managed portfolio. So when I called them and said, hey, I need you to stop what you're doing and get this, or here's my priorities, I need this unit and this unit rented out fast, right? They listened to me because they didn't want to lose that business. So having that scale is incredibly important.
Yeah.
And finding a reliable property manager is also incredibly important. We went through 4 in the first 2 years before we found one that we liked and stayed with.
Yeah, you hit it on the head too. You've got to vet your property managers as well, because those are essentially all the bills run through the property manager. And a lot of times they pay to make problems go away and not necessarily fix the problem. And there are different calibers of property management companies too. As you scale your portfolio, you might deal with a different type of property manager on a lower unit count, and then say you get over 200 unit complex, you got a full staff on site.
Yeah.
So the game changes tremendously, but on the run up, as you're scaling your portfolio, your property management company can make or break your portfolio as well.
Absolutely.
We've had our run-ins with experiences, and ultimately it comes down to it's an active business. If you own your own properties, it still has to be active on your part. If you're looking for passive cash flow and owning real estate one-on-one, it's a fairy tale, in my opinion, because it can be, but you'll ultimately be paying the price in the back door. You'll fill the cup up with money and it'll just fall out of the cup. You'll just keep filling it up. And that's what I wanted to get into is one side. You've been on both sides. You've been on active and passive income. Yeah. Can you elaborate a little bit on that front as well?
Yeah. I don't think, unless you're investing in a fund, right, all real estate has some active component in it. Even like I invest in syndications as well. I'm still reviewing their monthly report. I'm still asking questions, being involved in the process to understand where things are going. I try to give them as much freedom because I hired them for a reason, right? But it really just depends on what your needs are. A lot of the investors I work with on the agent side here in Chicago, you have to understand, Chicago is very heavily 2 to 4 unit properties. So depending on the neighborhood, the housing stock can be 50 to 70% 2 to 4 unit properties. So most of our client base here does what we call house hacking, right? You can buy a 3-unit property, live in 1 unit, right? Pay half of what you would pay having rent, right? Use low money down programs and then rent out the other units. But most of my clients still have full-time jobs, right? They have high income W-2 jobs, and this is just a way of a secondary wealth generator. So it's still an active investment for them, but they're buying in the right sort of areas where, again, you're getting 1 tenant call per unit per year. It's not a 24/7 job where you're having to deal with constant issues and tenants. So again, it really depends. There's no right answer of what works for everyone. It really depends on your strategy. I had no intentions of leaving my high paid W-2 job until I realized that I'd always made sure that my real estate never got in the way of my job. And then one day I realized that my job was getting in the way of my real estate. Nice. And I gave my notice and it's time for me to go. But that's not everyone's path, right? That's not the answer for everyone. Many people you can build up much more wealth if you keep your W-2 job and just invest, 1 property a year on the side in a good market that's easy to manage, right? That's a very good way of building wealth.
Yeah, absolutely. And passive, a lot of people don't know that passive investing is even out there available. They feel like if to be a real estate investor, you have to buy a property and hold it and make it cash flow and manage it. But passive investors, when you become a limited partner in a syndication, you actually get the better end of the deal. You're not involved with the day-to-day activities. You're still getting your depreciation. You're still getting your debt pay down, your amortization, your cash flow, preferred return, profit splits. And at the end of the day, you're not on call. So
Yeah.
there's a huge advantage to even just coming on a deal, just to be an LP and keep your W-2 job and let someone else manage the issues. Because at the end of the day, me and you, we deflect a lot of people from those issues because they're handled, they're taken care of, but you just don't hear about them because
Yeah.
they're taken care of through the management, just through doing what we know how to do.
Yeah. I mean, syndication's one way. I've also funded flippers in my local market. So I've done like private money loans. I've also done, there's a local hard money lender that I know pretty well. He does all the due diligence, right? I invest in his fund and then he
Nice.
allocates that money. So I'm totally hands off. Just like you would a syndication is not, but flipping, right, is active income, not, you don't get depreciation and the tax benefits. It really comes down to, choosing the right partner, whether that's, and if you're the active person, right, or if you're the passive person, is doing your due diligence, right, using that courtship time to choose that partner. The first syndication deal I did it's out in Phoenix. I knew the guy for, I don't know, 5, 6 years, right? I'd run numbers on a couple of his deals over the years. I had, paid attention. He had a blog. I would read his articles. Like, I knew who he was as a person, right? And then I just waited for a deal to come up that I liked. And that was he sent me over, all the spreadsheets, right? And all the numbers and stuff. And really, I only had one question for him, which was, why do you like this deal? Like, what gets you excited about this deal? Like, that's the question I want to know, right? Is why this deal makes sense to them, right? Besides the numbers and all that,
Yeah.
and he was able to answer that really quickly for me. I could hear the passion in his voice about, like, he was genuinely excited about this project. I'm like, cool, I'll wire you the money and now we've got a deal going, but it took me like that courtship period to get to know and trust him before I was able to do that.
Yeah. And as operators, we are extremely selective of properties that we want to move forward with.
Yeah.
They've got to make monetary sense, operational sense, time sense. You're going to be married to the project for call it 3 to 5 years, if not more,
Absolutely.
depending on your underwriting. So last thing an operator wants to do is have a miserable property and the returns not match with what performance should be. That's some operators might not be as selective, or maybe they're not true operators. Maybe they're relying on property management to do all of their value add for them, and they feel that they can buy a little differently. But that goes into I guess how everyone wants to invest in different personalities. I know us
Yeah.
as an
So
operator, we're selective.
So on that topic, right? I've got the capital, I'm investing in you as the operator, right? What's your expectation of communication throughout the project? Besides monthly reports, like, how often are you talking with the actual investors and answering questions?
So we send out right now. We just implemented CapEx, so it's weekly newsletters are going out with videos. So not only back it up with communication, but send videos, send proof that the crews are on site, send proof that the granite's being installed, the appliances are arriving, and then the before and afters, and then follow that up with a monthly newsletter summary of what just happened, what took place. Communication is 100% everything, especially when you have new personalities getting to know you. That's where you've got to double down and make sure that you're proactive on sending those communications out. Trust is built on performance. That's where, how can you measure performance? Well, it's not going to be out there watching them, but you can send communication. That's your performance level. And then be available for people to call in and ask questions and any comments, questions, concerns. We're bringing on a third party accounting firm as well to double down on our in-house accounting. So now they're going to have auditable financials on a monthly basis that make sure all the reconciliations are done, bank accounts, and on a property level, on an accounting level for each property. That's just another level, though, of building trust and
Yeah.
scalability. So there's different facets. Every operator does things different. I'm not taking away from anybody. This is just what us over here, what I feel would be best practices when entering new relationships.
Absolutely. So
So
what got you excited about your last deal?
it was just an incredible purchase basis. The age 1989. It's a C class. The in-place rents were substantially lower than what we knew the market could bear. But to reach those market rate rents, we have to spice up the property with through cosmetic renovations, nothing heavy. It just everything about it made sense. The numbers were in line. Right now, we're underwriting deals where they're trying to sell based on performance still, meaning that you have to raise the future raise rents to get to your properties at the end of the timeline where it would value. You can't do that. You can't buy real estate at a future value or how the property down the road is currently renting and yours isn't. So this one was based on
Actuals.
not even actuals. It was just really just mispriced. It was and it got us very excited. So we're having fun with it. But let's talk about you though. You're here. You love to travel, and how did real estate enable you to be able to travel more?
Oh, it's been the cornerstone of being able to travel. Again, coming from a corporate environment, I said almost 10 years I spent working corporate, where you get your crappy 2 weeks vacation, right? Which you still don't really get to take. Like you can't take 2 weeks at once, A, and B, even when you're on vacation, like you're still expected to answer your work emails, right? So like that was a really big emotional mental shift for me. Was the first time like I took off a month and didn't have my phone with me, right? Every single day.
Nice.
That was really like the I did it moment for me. But it was hard, it's hard to get there. And then really it becomes, once you do it once though, it becomes like non-negotiable. We try to travel about 2 months every year. My team is now in place to handle everything, no matter what business it is, right? Things are handled without my interruption or my need to interrupt me. And now it becomes, I deserve this. I am doing this. Like you can wait, right? And that's one of the things as an entrepreneur, learning to say no, right? Learning to value your time, learning to prioritize your time, right? Those are all things that every entrepreneur struggles with, and it has to fine tune and keep fine tuning to be able to live the goals that you have.
Yeah, that's huge. And then that's just proof that you're able to do those things through systems that you've set up on a personal level. And you didn't start out with being able to do that. You've worked towards being able to do that. And it's taken a lot of effort, sleepless nights, I'm sure, and just getting to a point where everything starts to make sense, and it's bearing the fruit of your labor. That's
because I
great.
started investing in 2011. I started my brokerage firm in 2014. We started the summit, the conference, in 2017. So it really wasn't until like 2018 that I had everything built up, right? Enough where I could go leave for a whole month and not be worried. And then I had my first kid in 2019 and it all went to hell. So
they do what they're supposed to do.
Yeah. You'll hear if you ever listen to one of my other podcasts, especially before I had kids, my big ultimate goal was to wake up without an alarm clock, right? Working corporate, right? Having to set that alarm like every morning, I hated it, so when I quit, I said 9 years ago, I quit my corporate job to do real estate full time. That was really like my thing was like, I get to wake up with no alarm clock. Like I will wake up when my body is ready to be up for the day. Right. And I talked about it all the time and bragged about how I could always just, I'll sleep until 8 o'clock if I want. Then I had children. My daughter gets up for the first 2 years of her life, got up at 5:30 in the morning. I finally got her sleeping till 6:30. And then like 8 weeks later had another baby. So I have really got, karma came back and spit in my face about that one.
Yeah. They're complete whores running around the house and destroying everything, but it's what we do everything for as well. It's
absolutely.
I tell my wife that it'll be over. It'll be over soon, and we'll miss it because it's
Yeah.
time flies. It's the bad thing. So, if someone is wanting to break into real estate, how would you suggest that they get started? I know you've started a conference, which is huge because that gets you in the room. What path would you tell them to take?
There's no one answer that fits everyone's needs, right? Really to start is writing down what your goals are, right? And then what your options are to get to those goals. So again, it could be, right, you could be house hacking, but if you're, I've got young children, right? That's probably not an ideal situation for me if I was just starting out now with two small kids to live in a small apartment, right? Just to reduce my rent. You can get into flipping, right? But flipping requires time and experience to learn how to do that. You could invest passively, right? But that again still requires time and experience to do your due diligence on the operator. So there's no one answer. Really, it's getting out and learning, changing your mindset. I find that a lot of people have to shift, right, their head, because we were all brought up to think that you go to college, right? You get a good corporate job, and then you do that till you die, right? And this entrepreneur, right, real estate investor world is very scary. It can be. I can go 6 months without a commission check. Our winter markets are terrible here. At the same time, right, my properties are not performing at their best. I can guarantee you that, right? Because it never works out that way.
Yeah.
That's always when the big hits come, right? Is when one thing goes, everything else goes. So for some people, it's quitting their job and going into this full time. For some people, it's keeping their job, right, and investing passively. Like there's no one answer. Listening to podcasts, right, reading books, going to networking events. Those are all ways that you can connect with investors. That's what I find to be the most beneficial, is hearing other people's experiences.
What are a couple books that you would recommend?
Well, I have to plug The One Thing, which is not necessarily a real estate book, but Jay Papasan was our keynote speaker at our event this year.
That's a great book.
It is a great book.
Yeah.
There's a ton of good books. Bigger Pockets has a whole list of great books. In about 3 months, I will be releasing my first book, so you can catch
Nice.
that. There's Never Split the Difference is also a good business book.
Yeah.
I really liked one of the Walmart Effect was one of the first books I read probably 20 years ago in business, that I found really interesting. Good to Great is also an oldie but goodie, more general business stuff than real estate, but there's a ton of resources available, right? The thing is, most people don't take action because they don't want to commit time to it, right? But once you commit the time to it, you'll see like this world is really insane, right? Real estate investors to me are such an awesome group of people because it's not just a business to us, it's a lifestyle choice, right? Most of us get into this for a lifestyle choice. So like our core foundation of beliefs are very similar. I always joke, you could pick any 12 real estate investors, lock them in a room for 24 hours, give them a few cases of wine. You will open those doors in 24 hours and they're still talking.
Yeah.
100%. They are still talking. Like we don't shut up. Once we find something that we like to talk about, we've got commonalities, we don't stop talking. So you can go to networking events and seriously talk for 3 hours with people, they'll close down the restaurant before they get you out of there.
It's truly a passion.
It is.
That's I just finished the book Becoming Pro. I would recommend that one to anybody. It was
What's that about?
Becoming Pro. So I listen to everything on Audible just because I can listen to it on the go and from point A to point B. But it takes from amateur to pro and what amateurs do versus what pros do. It's enlightening because everyone wants to be pro. Everyone wants to get there, and to hear how you can kind of resonate with some of the things that amateurs do. All right, well, I need to change some things up. So it's a good book. It was written back in 2012. It's just finished it over the weekend, so I'd recommend that one. And a lot of your books I have listened to as well. It's just absorbing the information. It's incredible what you can learn just from what others have written and their experiences. It's just it's gold nuggets.
And that's one of the differences too, I think, with real estate investors. The community as a whole is very big about personal development, continuing to read, right? Listening to podcasts, develop yourself, versus the corporate world that was never discussed. No one ever talked about what business books they read, right? Or what, time management thing they were working on, right? It was always like, come in, do the grind and leave. But this world is very, very focused on that. And there's got a million resources, but it's an ongoing, right? It's an ongoing thing. 12 years later, I'm still reading books and learning.
Oh, yeah. There's not enough time.
There isn't enough time.
Yeah. Learn about taxes, learn about underwriting, learn about everything is just like, man, but you can buy other people's time, which is great. It's just, you want to be competent in all of those categories as well to be able to communicate and make great decisions. There's just not enough time to absorb all the information. It's incredible.
No. So that's something that I like to talk about too. Again, I've got 3 different businesses. They're all related within real estate, but they're 3 very separate businesses. And at the time I was, still working probably 60 hours a week, those first few years building things up. It wasn't until I met my second husband, it was our second date. And it was like a random Tuesday. It was a beautiful day in Chicago. So we had taken the day off to go have a picnic. And at the end of the day, he's like, you got to get off your phone. Like every half an hour, you're checking your phone or writing an email or something. Like I took time out of my life to get to know you, and you're sitting here giving me half of your attention. So if that's how you plan on doing this relationship, like I can tell you right now, it's not going to work. And it really struck me, right? And took me aback, like, you know what, you're right. Like if you're taking time out of your life to get to know me, I should be committing time to get to know you. So I don't want to say forced, not the right word, but really opened my eyes to how many hours I was working, because I was always available, right? Especially with being an agent, like 9, 10 o'clock at night, I'm answering client emails, right? And talking to clients. And it was really counterproductive with the lifestyle that I had wanted to live. So I had to learn to rework my business. And part of that was outsourcing. So what I did was every day, at the end of the day, I would write down how I spent my day, right? I spent my day an hour doing accounting, right? 2 hours doing marketing, 5 hours on client calls, right? And then I put it into an Excel sheet. At the end of the week, I tallied it up and reflected on my week and said, okay, this is how I spent my week, right? What part of this do I enjoy? What part of this is revenue generating for me, right? And what part of this can I outsource? And so I would look at it and be like, I spent, let's say 8 hours this week on marketing. I hate marketing. I'm terrible at marketing, right? Who can I find to take that off my plate and give me those 8 hours back? And so that was my goal of that week, was figuring that out. And the next week I would write down how I spent my week and review at the end of the week, right? And like this went on for about a couple months, fine tuning my schedule so that I was like, okay, it takes me 2 hours a week to do accounting, right? I still like doing accounting. That's not something I want to outsource, right? And that's what I'm going to allocate to that task. It's not revenue generating, but then shifting more of my time to revenue generating activities. So I got to the point where like, I'm only working 30 hours a week and 80% of my time is spent on revenue generating activities. That's the best use of my time.
That's huge. That is absolutely huge. I'm glad you said that, because documenting what you've done, your daily growth drivers, and then where you spent your time that's the first step. That's huge. And then it goes from there.
How many times do you look back at your day and be like, what did I do today?
You set your 12-month target. Your 12-month target is your quarterly is monthly is weekly, and daily. And that's the ship's destination, but your targets should be in line with your goals. And we all get stuck in the weeds and we start doing things we shouldn't be doing, but outsource and calculate it and recalculate, I guess.
Yeah.
But awesome. Brie, if somebody wants to get a hold of you, learn more about you, how can they get a hold of you?
Sure. My social handle is Chicago Brie. That's CHICAGO BRIE. Across all platforms is probably the easiest way. Or you can visit my website at secondcity-re.com.
Awesome. Great talk. I appreciate your time today. I look forward to talking to you here soon.
Thank you.
All right.